I am here this morning, as we do every single month, with Larry Goldberg to talk about what Cathie Wood said, not on Friday night anymore. She's changed it to Saturday morning, Larry, making it more interesting for you and me to get it done this early.
Right. Good morning, Randy. Yeah, it's a little challenging to make it, early enough to get the information out, timely fashion. But really, I mean, Cathie is so fantastic. She packs so much into so little time. It's really, it's been for the years that she's done it, since she started doing it. I guess it started in the pandemic. It's been very valuable, I think.
I think so too. And I think maybe even her fans like me and you might have been a little surprised by some of her thinking this morning. And she spent half of the 45-minute program today talking about Bitcoin, which we'll put at
Yes.
the end. But that, of course, made her commentary on the general subject matter a lot shorter. That might actually be a benefit to you and me. That gives us an opportunity to be the ones who do the commentary.
Yeah, and I feel a little guilty doing the commentary, because what are we doing? We kind of just telling people what she just told us, but I think we can add something. I think we do bring something to the table. But I'm in awe of Cathie, so I tend to not disagree with it, although I do sometimes disagree with it. But
I mean, Larry, if you're going to disagree with me, you can disagree with Cathie. I mean,
fair enough. Fair enough. Listen, I've never been a shy person, so
yeah, we know that for sure. All right, why don't you go ahead and put it up, and let's we got some charts and graphs and stuff to go through. So
we do. So let me share my screen and tell me if you see it.
I do.
Good. So, this is an important particular piece of video of hers, because she's talking about 2023, and we're right at the beginning of 2023. So this is kind of setting the stage for the year. And it's interesting that she starts by saying in 2023, clearly the markets start to understand that the Fed is about done with raising interest rates. But at the same time, 2023, the markets have kind of plunged. I don't think it's deadly serious yet, but it's definitely taken a turn for the downward swing. And I think the reason...
I'm sorry. Let me be clear. Are you saying in the first 4 days of
2024. Wow.
Yeah,
Yeah.
yeah. I want to make sure.
But
Okay.
in my rush to get this headline done, I put the wrong thing up. It's 2024 disruptions ahead. So everybody, where you see that headline, it's not
Yes,
2020.
yes.
It's 2024 disruptions ahead. So in 2023, we started to understand that, we're about done. They kept saying higher for longer, and some still say that. I heard Larry Summers at the All-In Summit talking about how bad things were going to get, and how we had to hold longer in terms of inflation. And he's still saying that, but I think the market has seen through that, and Cathie says the market's seen through that. But the long duration assets, these bets on these huge disrupting companies that are a 4 to 10-year cycle, really got hammered, and ARK got hammered as a result. And even Tesla actually suffered, is suffering from that as well.
The end of last year and the beginning of this year, Tesla has reverted to being treated like the Cathie Wood stocks.
Yes, that is correct.
And so it's been interesting to see, because Tesla had moved to being treated more like a NASDAQ, although sometimes, of course, it diverted from everything on those really good or really bad days. But in general, it was moving like the NASDAQ more toward the end of 2023. Now in 2024, at least, well, again, the last couple of weeks of 2023 and last week, it was down more like the Cathie Wood stocks were. Even every day you could kind of chart it like the Cathie Wood.
Yeah. Yeah, and the bottom line is that ARC was saying inflation is transitory. It's a holdover. It's an artifact of the pandemic because people overbought in the pandemic, and now they have to work that down. And people do not realize that that's really what's happening, and so they're treating it as true inflation. And so ARC has been saying that for some time, and they say it's going to flip negative this year. And really, in a way, the way the markets have opened in this year, they're kind of recognizing that.
I mentioned last week a couple of articles, very unusual for me to bring up on my show, any of the bears, but I did mention a couple of bears last week that are suggesting that one of the problems is that we won't get the stimulus that we got last year from the federal government. So while the stimulus will be the same as 2023, it won't be increasing dramatically like it did in 2023. So you're Goldberg, he's Goldstein, I think it's trying to remember. Anyway, one analysis was that it contributed 4% of the 5.2 in the third quarter was from government stimulus.
Yeah, it's more than possible. It's more than possible. I mean, we'll see that, that money supply is collapsing right now. And I think that will have an impact, or that has had an impact on the market. And I think that kind of echoes what your analyst is saying.
Right.
But let's have a look at and then the key to what Cathie is saying is that we've been in a rolling recession. Well, I've been singing that song for a while now.
Right.
And so she says we've been in a rolling recession for 2 years. And here's some of the evidence. Housing measures are down 40%. New and existing home sales are as low today as they were in the depths of the 08, 09 recession.
For a completely different reason. I think she should have said that. It's a completely different reason.
No, but it is a completely different reason. Right. But the point is, it's happening, and that's a sign of a recession.
Right.
You don't have home sales go down to those levels, which were extreme recessionary levels because of the mortgage crisis. But when you get to those levels, you are in a recession, certainly in the housing market.
Right. Yes, that's
if you get auto sales, 15 to 16 million, that's recession-like.
Right.
Commercial real estate is in a world of hurt. So, if it looks like a recession, if it feels like a recession, then, so.
And she left out a big one, Larry. She left out manufacturing. So
she tackles manufacturing later on, but you're right. You're absolutely right.
19 months in a row, 19 months of down negative on the manufacturing sector.
Yeah, we'll come to that when we start looking at the Piper Sandler report, because they actually track. She actually tracks. She reproduces those slides and shows how the stocks in those staples have really taken a hammering, a real hammering. And that kind of is reflected back into manufacturing. I mean, that's the whole thesis, that everybody's overstocked because they were the boom in the pandemic led to, the great times are here, and everybody over-ordered. Now they're overstocked and they have to work that stock down.
Yeah, Larry, let me reflect on that just one more time, though, because I think it's really an important lesson for all of us in terms of boom bust. It wasn't just that everybody had a lot of money in their pockets to go out and buy these products. It was also that there wasn't enough of them And that causes everybody in the supply chain to overorder, not just because they think they're going to sell more, but because they can't get it.
Yes.
And so they buy double and triple the amount they normally would because they can't get it. And then all of a sudden it's in ships at sea, it's in raw materials in plants, in manufacturing plants, it's everywhere. The entire supply chain backs up with double to triple what you would normally have. And then all of a sudden, all of the inventory is in people's homes. And people don't need any more. They bought all they need of that thing. and then the sales just stop and those inventories become huge. And one of the things she didn't mention in the inventory section, which we could talk about then, but since I'm talking about it now, that inventory is also potentially getting stale, out of date, being reduced in value by virtue of shrinkage of various different kinds, theft, mold, mildew, whatever. But inventory becomes less valuable the longer it sits in place. Right. And that also is going to be a factor in a potential recession, maybe in the third quarter.
Older models that are no longer current, just a whole lot of reasons why inventory loses its value.
Right.
And of course, what happens is that, in a supply chain disruption, people think that's never going to end, and they keep piling up, and that stuff, as you say, is sitting in docks and ships and wherever. And then when it arrives, it always arrives at one time, and then people can't even afford to pay for it. And so we have bankruptcies. And so, yeah, it's a really bad situation. And so companies lose their pricing power, and they're going to have to cut prices. So unemployment will continue to go up, even though it's still at very low levels, but it just turned the corner, and the Fed overdid it. Now, one thing she doesn't talk about is the total employment levels.
Right.
And the declining rate of growth, or the aging of the population.
Right.
And that really plays into it very heavily in this case, because the unemployment rate is exaggerated downwards. In other words, it looks lower than it really is. It looks higher than it really is. There's more unemployment than we think there is. That's the bottom line. So
we only added in 2023, we added half the number of new employees that we did in 2022. So that, I thought, started to speak to your issue of, yes, of course, when you're already way up here in terms of the number of employees in the system, it's going to mean there's not enough left to hire. So that's going to reduce the total number. But in fact, the actual number being half of what was added to the employment in 2023, that's significant.
Yeah.
And would suggest a trend to potentially being maybe capping out, maybe getting to the place where we're going to see some months where there's no increases or negative.
Yeah, the bots are going to come to the rescue. This is, the bottom line is that, Tesla and all the other manufacturers of humanoid robots are going to solve the problem, because the problem is, it's just population. Our population has peaked. Fortunately, not as bad as the rest of the Western world and the rest of the industrial world, but China is in a world of hurt. Europe is in a terrible state. It's terrible what's happening to the population. And it's in the non-industrial world that population is still continuing to grow, which is kind of, it's kind of a trap that both worlds are in anyway. So, yeah, so the unemployment rate will continue to go up, and it's still at a very low level, but we don't really believe it is. I don't really believe it is at such a low level, but it has turned the corner, and the Fed has overdone it. unnecessarily. That's Cathie's thesis. She says that the recession will not be as serious as 08 or 09 because of this rolling recession that we've been through. There's so many areas of the country, so many areas of the economy are in recession. We won't, really have as bad a time as we had in 08 or 09. And the recession, quote unquote, that finally the Federal Reserve will recognize will be actually the tail end of what was the rolling recession. And interest rates, inflation, and real growth are going to surprise on the low side of expectations in an election year. And again, the observation we should make is that the market may be beginning to reflect this.
Could be, yes.
And that may be the reason for the poor performance of the market. And we may be going through another downturn in the market as we go through this process.
It was interesting, Larry, last week, maybe you did the same thing, to watch. I typically watch, 4 or 5 pundits a day on CNBC. They were almost white-faced last week. It was like it wasn't so much that we were down 3% on the on the S&P, or 2% rather on the S&P, or 4% on the NASDAQ. It was more that they weren't expecting it. And that everybody was so positive on the economy for 2024, and then all of a sudden the first week just falls apart. And these expressions were almost, you could almost capture the expressions as people were rethinking, almost having to recalculate on the fly as to what this all meant.
Yeah, they should listen to me. I've been telling them for a year. So then we start with the fiscal charts. So let's get straight into her charts. And, there's a lot of them, and we've taken a long time over the introduction, but she starts with, public debt outstanding, and everybody's a Twitter about this because, now the public debt outstanding, which is the purple line, the total public debt, that's the debt of, the federal government, has passed the nominal domestic product, the GDP.
Right.
It's supposed to be such a terrible moment, blah, blah, blah. Cathie then goes on to explain, guys, that the federal debt is like a stock of debt. GDP is like a flow. They're not really directly comparable, right? So, and her thesis is this is not the end of the world, because innovation is going to drive dramatic growth, and the growth is going to exceed, the growth of GDP is going to exceed the growth of the debt. So, this chart is kind of a reflection of this. This is the ratio of that green line to the blue line. So this is total debt outstanding divided by GDP. And her point is that there are times, even though there's been a secular climb, there are times when it flattens out, and those are times of massive innovation. And so, the thought is that, this is going to flatten out, and we're going to all be fine, and everything is going to be rosy.
And I don't think that you think that's true. And I don't think I think it's true either. I think that there's a reckoning for this kind of debt. You can't continue this process forever without having it impact.
Well, be aware that if you have a massive amount of growth, that solves the debt problem.
It trends the debt problem in the right direction, but it doesn't.
No, it solves the debt problem.
Okay.
Because over time, if the growth, let's assume growth continues to exceed the growth of debt by a factor. Let's take an outsized case of 20% growth versus the debt.
Right.
Then what happens is that the GDP, let's assume, goes to 100 trillion.
Right.
And the debt remains at the 20, 30 trillion,
Mhm.
then suddenly the amount of tax you need to pay down the debt is negligible.
Mhm.
Everybody's asked to pay an extra 1 or 2%, you pay off the debt and you're done.
Mhm.
So that's the extreme case. Of course, you never get to that level
Right.
of extreme.
Right.
But if your GDP grows at a significantly higher rate than the growth of the debt, then the GDP will definitely overwhelm the amount of debt in due course.
But what we've proven in California is that the public seems perfectly willing, even in the most robust years, to just take all of that extra tax money and add new programs. So I have no faith that the federal government will be any different going forward. And we'll just
Yeah, so behaviorally, the answer is that no matter how fast the GDP grows, the government is prepared to spend it faster. That's what you're saying.
exactly.
So yeah, in that case, yeah. So mathematically, what I'm saying is correct, but
Yes. No, no.
behaviorally, what you're saying doesn't matter.
Right.
You may be right. Money supply.
Yeah.
Well, money supply grew like Billy-O, at incredible rates, probably faster than I don't know that they've ever grown at this level of rate.
I doubt it.
Ever in the history.
I don't think so.
But it's collapsing now, although was a little, we've pointed this out in our conversations. It's collapsing pretty rapidly. M2 is down to -5%.
Larry, be sure to point out that this is an extension. So where the green line ends is the actual. So this is where we are right now. She's extended the amount into 2025.
Well, actually, this is M2. The blue line is M2.
No, see, notice that, look below, see, it's 24 and 25. So what she's done is she's given a projection of where she thinks it's going to go past where we are.
Are you saying it's leading by to 24, 25?
Right.
I see what you're saying. Yes. So I missed that. It pushed ahead by 18 months. I'm sorry. Yes, you're absolutely right. Yeah, I prepared these so quickly, but I mean, that's a very interesting observation. And I wonder if that's really going to happen.
So what she believes is that the money supply is going to continue to drop in the first half of 2024, but then the Fed is finally going to realize they can't continue to be restrictive at some point, because the money supply is going to, I believe, this is my personal opinion, the money supply is more affected by what the Fed is doing in terms of buying and selling assets than it is by the interest rates that it's setting. And so at some point in 2024, they're going to go, oh my gosh, we've overshot on that as well. And we either need to start buying up some of these assets again, or we at least need to completely stop selling them.
Yeah, I think the one thing that Cathie needs to pay attention to, though, is the velocity of money. I mean,
right.
V2 has not risen at all. In fact, if anything, it's declined. And so this increase in money supply, I think, is less serious than the Fed makes out. And if it were to collapse, that would be quite serious.
Right.
I'm not sure it's likely to collapse, but maybe she's right. I mean, it's going to be interesting to watch. But I'll tell you, the stock market is saying that things don't look good, and Cathie's telling us the reason why. And then we have the so-called yield curve. Again, the yield curve, is a really bad indicator. There's almost never been a time when the yield curve hasn't gone inverted, which is to say that the long-term bonds pay less money than the short-term bonds, which is completely unnatural. Long-term bonds should, of necessity, because of risk, pay a higher interest rate, but they're paying a lower interest rate. And that is always an indicator, has always been an indicator, almost without fail, of recession. And we've had that inversion now. There it is. Each inversion, each time you get below this line, this is 0.
Mhm.
Every time you get below the zero, you see this gray bar of recession. You're down there, gray bar recession. Down there, gray bar recession. Down there, gray bar recession. And here we are. We touched it, but didn't go below it. But we've been below it now for a record period, by the way. It's
Yes.
been longer than almost any recorded history, in recorded history. And so you would expect there to be a gray bar here. And I think we've been in a gray bar. And I think that's the point Cathie's been making, that there's been this rolling recession. And people just not feeling it because the massive amount of cash that was put into their pockets during the pandemic has cushioned everybody. But I don't believe that it's real, and I think I think the time has come to pay the piper. So I think we'll see a gray bar without too much doubt. At least I believe it, and Mayor Thaker believes it.
Well, again, I talk about this a lot on my show, Larry. I have a little bit of a weird impression that we might be seeing some kind of a shift in the way that the market is working in the short and long-term bonds, because as you mentioned, this is 18 months now. The longest ever, according to Cathie, was 19 months. It's also deeper and steeper than it's ever been before over that kind of a period of time. Looking at a full half of 50 basis points on the 2-year versus the 10-year for almost that entire period, and sometimes greater. If it goes much further, and we're beginning to see a little bit of shrinking in that 2-year.
Yes, we are.
But not on the 2-month or the 3-month. It's continuing to be extremely wide. In fact, sometimes expanding. So we'll see what happens over these next couple of months. But I'm curious how this will play out. The economists may be talking about this in a year because we've never really seen this before. And right now, there's zero punditry. I mean, I keep asking people, please send me the article. That nobody is talking about the inversion curve. Cathie's the first person that's talked about it since she talked about it 2 months ago.
Well, I think that there's almost certainly going to be, Cathie talks about a reduction to 2% in the long-term bond. Now, just so our audience understands it, that's the opportunity to double your money.
That's not investment advice.
That is not investment advice, but if she's right, long-term bonds, they won't double, but they'll definitely increase very dramatically.
Right.
And we've spoken on this program before, on our sessions before, of the the opportunity to buy these long-term bonds and make significant amount of money. Short-term bonds will not do it for you, but certainly the long-term bonds will show very significant growth in value, in face value, if the mortgage rate, if the long-term bond rate drops from its current 4+% to around the 2% mark.
So that was the first shock for me in her presentation. That's quite a call.
That is a big call, but she's not the first one to make it.
Oh,
I spoke before. There's one of the most highly see, there it goes again. I just can't.
I had the same problem earlier.
Can't fish the name out, but he made this call, about 4 months ago. What was he? It'll come to me, but he made the call about 4 months ago, and that was when it was at 5%. So
right.
He was saying that he'd bought just about all the bonds he could lay his hands on. He's already up, a good 20%. So
yes. So of course the point she didn't make, and I think it's important to restate this to, for the
Druckenmiller, Stan Druckenmiller.
Yes, yeah. So for the purposes of what we're talking about here, if inflation, she goes on to say she believes inflation will drop below zero. So we'll get into actual deflation. Well, if that happens, the bonds, the treasuries will definitely be at 2. I mean, there's just no way that doesn't.
That's right.
Yep.
That's right. Yep. Treasuries were for a while almost 0.
That's true. Yep.
And by the way, if treasuries really get down to that level, then the US will be able to issue 50-year or 100-year bonds.
Maybe they'll listen to you this time.
Maybe they'll listen to me this time. Yeah. So here's the really shocker. I mean, this to me shocked me because this is not Cathie's projection. This is the 10-year yield minus the 3-month yield inversion. And
right.
This inversion is like never been seen before.
Yeah.
It's incredible. So, we've been through the rolling recession, so that may offset a very significant portion of this rise. But when you look at this 10-year yield minus the 3-month yield, the number of days it's been inverted, this is the inversion length of time before these other recessions that have occurred. I mean, they reached, 100 days, one even reached 200 days, but typically they're down here, at the 100-day mark. We're at the 300-day mark.
I'm just going to throw it out there again, Larry, just briefly, that I have my little weird theory, and I could be completely wrong, but it doesn't hurt to theorize, that the way that people over 55 invest is completely different than the way that people under 55 invest, and that this could be affecting the entirety of the market situation, and why that would necessarily create an inversion, I haven't quite figured out, but
well, if you're right, it should be the other way around.
Well, you might think that.
I would say that as you get older, you want to invest in safer, longer term.
Yeah.
And so you'd think it would work the other way around. So your formula, your theory makes matters worse, not better.
Yeah, yes.
Better back off from that.
I don't know. I haven't figured it out yet, but I think that's what's going on. Anyway, go on.
Right. And then we can look at the economic charts. We'll do this really quickly. This is something that, is really frustrating, Cathie, because she says every reserve bank, every Federal Reserve, I think there are 12 of them, right? But every Federal Reserve has their own economist. Each one of them are publishing about the recession probabilities, and each one of them is saying it's high. And the Federal Reserve is still just clamping down on the money supply, raising interest rates.
Yes.
How, it's a sign of genius if you can hold two opposing ideas in your head at the same time. So maybe it's the sign of their genius.
Yes, maybe it is, but it's
they're showing this massive recession probability,
right,
higher than at any time except the 80s. The early 80s, which was just like one endless recession. And yet, despite that, they've raised interest rates, consecutively, nonstop
at the fastest rate ever in history. Yes.
Yeah, it makes you wonder. It makes you wonder. And by the way, Janet Yellen is walking around town. As I say, every time
all good. Yeah.
all good. We missed it. Soft landing. It's beautiful. I'm telling you, when an economist tells me we've just had a soft landing, I get worried.
Well, and the other thing that worries everybody, of course, is when all of the economists are agreeing.
Oh, that's terrible.
And all the pundits are 100% sure that this has been a great year. That was my first that was the first thing that got me to start thinking, is when everybody's rosy. Not good.
But if we look at the Conference Board's leading economic index, I mean, every gray bar, every recession has been called by the the leading economic, the conference board's leading economic indicator. And here we are. Here we are. Although it's trending up a little bit, I see.
So Larry, the interesting thing about this one for me, this is personal again, is about 4 months ago, 3 months ago, I said on my channel, when they were reporting this, leading economic index, I said, nobody's paying attention to it anymore.
Yeah.
I can remember years ago, this was like the number one thing everybody looked at every month was, what is the conference board saying? And now nobody's paying any attention to it. And I even went so far as to say, well, maybe people don't find it predictive anymore. But maybe it will end up being this time, because again, I think I think it's 19 months in a row that the conference board has been showing negative.
Is it possible that people's attention has just been captured by the Federal Reserve's constant clamping down on the money supply, that they're, sort of disregarding it? It's possible.
Yeah.
It's possible.
It's been all about the bonds.
Yeah. Yeah. And then continuing jobless claims. Well, we've discussed this thing at length, this strange disparity between the unemployment rate and the economic activity, climate. And yet, the nominal GDP continues to grow. Each quarter they're
Right.
reporting a increased nominal GDP, even though we see these portions of the economy in severe recession. So the question is, where's all that economic activity taking place, and why are there no jobless claims?
Now, Larry, again, I felt like she didn't go into enough depth here, and I think that she normally would have if she had taken more time. What we have is the major corporations and even the mid-sized and maybe even some of the smaller ones did not fire anybody. They didn't fire anybody. They could not find enough workers. And so whatever worker that they got in the building that they kind of liked and thought maybe might work out long-term, they just kept them. This does not normally happen. There's some, Druckmiller and not Druckmiller, who was it? Drucker, who said, once a year, fire 10% no matter what. That did not happen. And so what you have is no.
Yeah, I mean, look, Harvard Corporation didn't fire its president because.
Yeah, that's right. But you basically had nobody getting laid off during this 3-year period because there was nobody to hire. Right. And that's still true. 1.4, job openings for every person looking. So what this year could see is a beginning of that pairing off, which we haven't seen. And this is another rolling indicator. This is another one of those things we've never seen before. In my 50 years in business, I was never in a situation where we had where you just never fired anybody.
Yeah, but the pandemic had a lot to do with that.
That's my point. Yes.
A lot of people took themselves out of the job market. Yes. And this happened at the same time as we've seen this reduction in the population of employable people.
Right.
And people who normally would have worked on past the age of 65, because there's been a long history of people continuing to work after 65, stop doing that. Yeah. And so you had this combination of events that I think, caused the unemployment. But she says, Cathie tells us, that actually it is trending, even though the green line, which is the total employment, non-farm payroll, is still trending up. This temporary help is beginning to collapse, and that's a leading indicator. So,
but here again, Larry, that's my point. This is exactly my point. Multiple people pointed out yesterday that the non-farm payroll information on Friday showed a loss of full-time jobs and an increase in part-time jobs. This is showing that the temporary market is dry. Once again, that's why I'm trying to point out this unusual situation, which is going to play itself out. Okay, you don't hire temporary employees when you're already overstocked with people.
Right.
You haven't laid these people off in 2 years.
But the unemployment figures, as I understand them, may have shown growth, but they were adjusted down for the previous period
Yes.
such that the net is no growth at all.
Exactly. Again, 200,000 a month this last year versus 400 a month the previous year. So the employment rate is leveling off. What I'm saying is that these companies are loaded with employees. They have no need for temporary help. That's what's going on here. Normally you have these swings, seasonal swings or et cetera. You didn't need seasonal swings this year because you already had too many employees. Cathie said later, I think she said it, if she didn't say it, somebody else did, is this year, she said it, is this year these companies are going to have to start laying people off or their margins are going to collapse because they're going to have to drop their prices. And the only way they're going to hold their margins is by laying people off.
Definitely said it, and it's coming up very shortly.
All right.
So now she gives us it's very interesting. She gave us some slides now from Piper Sandler analysis. And they were very, very indicative of some of the things you've been saying, because she looks at real revenue from FedEx Corporation. FedEx Corporation has seen a decline of 13% in late 23, although there was this seasonal pickup, but huge reduction.
Right.
Huge reduction. But even more worrying is General Mills. Now, General Mills manufactures, staples.
Right.
Look at this.
Yes.
Real revenue, seasonally adjusted for General Mills.
Down dramatically. Yep.
And so, what happened? They jacked up their prices.
Yeah.
Because they felt they could. And what's happening is unit growth has collapsed.
Right.
And so what they're going to have to do is they're going to have to cut back their prices quite dramatically.
Yeah. And let me add 2 points. Number one, in terms of the overall trucking industry, even as the economy has been up all this year, overall trucking tonnage, which I report on every month, nobody else looks at, but I consider it to be the canary in the coal mine. Overall trucking tonnage has been flat the entire year, up and down, but flat for the entire year as the GDP has been going up. Tells me that all of the GDP increases come out of services, government, education, et cetera. That's where the GDP increase is coming.
And increased prices.
And then in terms of the General Mills situation, you had a major US grocery chain yesterday take Pepsi off the shelves.
Wow.
Take Pepsi off the shelves because of the price increase they were asking for.
Yeah, so what Cathie said was that that consumers are trading down to store brands.
Right.
And so that's kind of the indicator. That's where General Mills, revenue is going down, Pepsi's coming off the shelf. So, we're doom and gloom this morning, right?
Just reality, Larry.
Reality. So now we're looking at inventories, and this is an interesting number. These are interesting numbers. This is showing you, manufacturing inventories. That's this one here I found the most interesting.
Yeah.
This is wholesale inventories without motor vehicles, and this is retail trade inventories. So all of them, through the roof, and now they're going to have to come down. And that was your point much earlier this morning.
This was my second shocker. You had your shocker, and this was my second shocker. You hear the inventory reports each month, but to see them put on a chart over time changes your entire thinking.
Yeah.
I had no idea the inventories continued to be this completely out of whack. And this is a real telltale. This again, I don't want to be doom and gloom, but my inclination after listening to this and even after last week was to start figuring that they're probably, the recession that is being talked about for the third quarter wouldn't be a dramatic recession. It would really just be a matter if you can't get another 5.2, you can't hit the numbers that we hit this year. It's always a comparison of the previous year. So probably going to be in negative territory in the third and fourth quarter of this upcoming year, just because of not being able to hit those numbers and some of the other factors we've talked about. So talk about a weird situation where we might have a recession going in right into the election season.
Yeah, I think that we'll hit the peak of election on the 4th of November.
Yeah, yes.
So, here are some of these charts that show real capex and intellectual property. It's coming down. I mean, the growth has been phenomenal.
Right.
But it's definitely coming down now in software. I see it, I have great visibility into the software world, right, because that's the world I come from. So I have friends and, directly in these companies, and I'm still in touch with all my old colleagues. They are struggling.
Wow.
I mean, it's a business where if you don't make a 20% gain for the year, you're not doing too well. And they're flat. They're flat.
Huh.
And, even in intellectual property and R&D,
yeah,
it's been a big collapse. I've seen it. I've seen, management pull back on R&D very heavily across the board. Well, we've seen so many of the startups fail. We've seen so many of the startups have to recapitalize, in a very adverse circumstance. So this doesn't surprise me. And then if we look at real capital equipment in computers and peripheral, that's the hardware side of it.
right.
Well, they're way below recession levels. They're in a world of hurt. Of course, again, they overstocked, to your earlier point,
right, right.
In the height of the pandemic.
And Larry, again, this is one of those situations where you look at this situation in particular on that hardware side, and you say, okay, they overstocked 2 years ago, and now it's collapsed. But then there comes the point at which, in a boom bust cycle, there comes the point at which you go back to people finally needing again.
Yeah.
And so this is maybe in some of these categories, and it might be the third quarter, it might be next year, you'll get through this cycle and you'll get back into a normal cycle where all those inventories are normalized. I mean, I say all, advisedly, but you get normalized on the inventories, and then people do need to start buying again.
Yeah, I think that's true across the board. And I think that's the reason Cathie's saying that, this is not going to be a really serious recession, that a lot of people, will get through this and be ready to come out the other end. And, computers and peripherals are a good example because, to sustain this AI push forward,
right,
we're going to see a recovery in computers in order to take advantage of it.
Right.
So, yeah, I agree with you. I mean, look, every boom and every bust has within it the seeds of the next stage. So in the boom, you've got the seed of the bust, and in the bust, you've got the seed of the boom. And this has been such an unusual recession because it's been so spotty. It's been so, in different places, so different in different places that, we've got this thing rolling, and the rolling recession, I guess, is less painful than a deep recession.
Could be.
But yeah, these things are very delicate. The balances are very delicate. And, war in the Middle East, war in Europe, could upset the apple cart, and we could go into a very deep recession. And that's always my worry. And I try and hedge against that.
Sure.
So monetary issues, and we'll deal with these really quickly. The dollar's strong. Not as strong as 1985, but it's nonetheless pretty solid. and other currencies are obviously hurting. So everybody's kind of trying to get the dollar back down again, which is good for world economy. But Japan, we haven't spoken about China, and Cathie hadn't dealt with China, but China's in a very dangerous situation. I don't like the Chinese situation. I haven't liked it for some years now, and I like it less now.
Right.
That could be the joker in the pack.
Could be.
Very serious joker in the pack. And that's probably one of the real sources of the dollar strength. Bloomberg Commodity Index, we're at the 100 mark. I think, I think it's okay. I don't know why we would be that concerned about it.
Oh, not at all. In fact, what you're looking at, of course, is that the commodity prices are the same as they've been for 30, 40 years, 50 years.
It's not inflationary.
Yeah, it's not inflationary at all. And I was wondering when she showed the chart again, because I've been paying attention to this commodity thing a lot more the last 6 months. When we look at this situation, are we maybe again looking at efficiencies? Are we looking at efficiencies of getting this stuff out of the ground and getting it refined and getting it moved? Maybe that's why commodities have been able to maintain kind of the same levels over this long period. Just we're getting better at extracting and bringing to market.
Yeah, it could be. I mean, it's really it's probably a good indicator. And I don't understand how this ties to this Fed excitement about inflation. It just doesn't seem to tie in. Maybe I'm wrong, but
well, you have all kinds of things that contribute, let's say, to the end product. I'm a manufacturer. You have the raw material cost, but you obviously have your labor cost. You have your building cost. You have your electricity. I mean, for me, my second biggest bill was electric. After my rent, that's not true. My payroll was number one.
Yeah.
But after that came the rent and then the electric bill. So, the electric bills are way up in most parts of the United States. That impacts the final cost of the product. The freight rates were dramatically going up year after year after year.
But your raw material input must have been a very significant number.
It was a very significant number. The plastic pellets that I had to buy by the trainload was a significant number. But those were always, again, to the efficiency idea. I've talked about this on the show before. With plastics, a lot of them can either be oil-based or natural gas-based. So every time that the price of the natural gas-based ones would go up, well, you just switch. Your salesman would even say, "Oh, I think the next rail car you buy should be the opposite," because so there is ways of
both of those are impacted by commodity index. So I mean, they don't always just mirror each other 100%. They also mirror each other at the higher levels. So
yeah.
All right. So and then finally the metal to gold ratio, which is interesting.
This is weird.
I mean, it's very interesting. It's been so constant for so many years, and now it's moved apart very dramatically. And so this is a very, very, very tough number when you have such a disparity, and it's not a good indicator. And this is a strong argument for the Fed to ease up.
Larry, of interest, you may have seen that the Costco is now offering 1 ounce gold bars.
Really?
And they can't keep them in stock. They're selling 1 ounce gold bars like there's no tomorrow. So maybe there's a move into gold for some reason that has more, again, to do with overall nervousness, overall inability to understand what markets are doing these last 3 years. The aging population, again, could be part of it. Some kind of conservatism. I don't know, but it's I look at this and I look at that thing where Costco decided to sell gold. This is like 4 months ago. They started selling these 1-ounce bars, and it became a headline, became a national headline as to how much of it they were selling.
So just to understand the chart, this is the 10-year Treasury yield. See, it's right up to this 4%, was at 5%. And this is the metals to gold ratio. And so this has been, for the last, I don't know, 30, 25 years. And it parted in the 2000s quite considerably, 1998 to 2000. It's interesting.
Yes, extremely interesting.
All right, so gold bars from Costco. Hey, who'd have thunk it? So a gold to oil ratio, it's saying that gold's purchasing power is going up, and when it breaks through 30, Cathie says, we're usually in some kind of crisis situation. So the gold to oil ratio is, the price of gold versus the price of oil. And she says that when it gets above this number, it's a crisis. So you saw the crisis in 2020, which was the pandemic. You saw the 2014 crisis. So we're at this point where if the Fed doesn't pull back, we'll be back in the crisis.
Yeah.
And then she says, don't worry, everybody. Innovation will solve the problems. And
the most innovative company is Tesla.
we know that. Our audience understands that. Right. And you want to talk about Bitcoin, or have we gone on too long? I mean,
I think we promised it. So let's give them a couple of minutes at least, Larry. You can do all the talking, because I'm still I know so little about it that it would be scary if I said anything about it.
So Cathie brought on the head of the research group in her company that does Bitcoin, Yasin, and I'll murder his last name, so I won't say it. And Yasin, I've followed Yasin for a long time. He's very, very, very solid, and so the key is, within the next month, we expect the Bitcoin ETF to be approved, or Bitcoin ETFs to be approved by the Federal Reserve Bank.
Next Wednesday, I think.
Not the Federal Reserve, sorry, the SEC. Next Wednesday is supposed to be the date. I mean, things can go wrong. They can say no, but
right.
And what Cathie is saying is this is a very important moment. It'll be good for Bitcoin. It's bullish for Bitcoin. But what she's saying is it's a really good investment for the investor, because Bitcoin has a long-term asset that is a good it's a good investment in time of crisis, and it has a very good long-term opportunity. And Yasin has prepared some slides that indicate that. So we can start by looking at this interesting slide of Bitcoin price in US dollars, which is this black line, up and to the right. Notice, up and to the right.
Right, right.
What these blue lines are the moment in time where Bitcoin has doubled, has halved, has halved in production.
Right.
So the whole point about Bitcoin is every so many years, and it's roughly 3 to 5 years, but in that mark, the production of Bitcoin halves. What that does is make sure that, by the time it's halved and halved and halved, it's got to the end of the maximum it'll ever be produced. At that point, they stop producing it. There is this very clear, understood knowledge of the absolute maximum Bitcoins there can be, which is the opposite of what you have in, currencies, in money that governments produce, because that there's always going to be more of it.
Right.
And so over the long term, this should hold the value of Bitcoin. And one of the interesting features of the exercise is that if you look after each halving, there has been quite a significant bull market in Bitcoin. Those moments are probably responsible for most of the increase in the price, in the value of Bitcoin.
Right.
And the halving is due within the next year or so, or very shortly, in the next year or two. I'm not sure exactly when. And so they're calling for, significant increase in the price of Bitcoin, which has increased quite a lot, actually, in the last little period of time. And that increase is somewhat caused by the fact that we knew this ETF decision was coming down, and we believed it was going to be positive. So that has supported it as well. But nonetheless, over time, if you look at Bitcoin, it's up and to the right. And it's been consistently up and to the right. So, that's a pretty good indicator, I think you'll say. And so, the notion is that, these are moments in time that you get this big increase in the price, and they're bullish about it right now.
Right.
That's the basis of the theory.
Okay. Well, Larry, I still have my doubts.
Here's a very important slide for you, for you doubters. Here's a price of Bitcoin since January 17th. This is the supply of Bitcoin held by long-term holders. Long-term holders are holders of 6 months to a year and beyond. 6 months and beyond. I think that's not a good cutoff. I think the cutoff should have been closer to a year or beyond. But it just shows that, the long-term supplies, the long-term supply holders, I'm not sure what it shows, actually. It seems to move in direct opposition to the price.
So the price goes up when the long-term holders have less?
That's what it looks like to me.
Yeah, I'm not sure.
Well, what they're saying is that 76% is locked up in a way that you're not going to see marginal demand. The marginal demand is supported by by supply.
Right.
And particularly when it halves, it's even going to get worse. So Yassine is saying that, that's a bullish indicator. So really, that's their thesis. I mean, so far, if you're a long-term holder of Bitcoin, you've done extraordinarily well.
Very well, yes. There's no doubt about it.
Yeah, and I have very little Bitcoin. I think I've got $600 worth of Bitcoin.
But you started with only $25.
I started with $600. I think I've only just got back to $600 now.
Okay.
But I have family members who have done extraordinarily well with Bitcoin over the years, extraordinarily well, and it's very hard to argue against Yasin's logic. And he called this last rise quite accurately, because I follow them quite closely, and about 6 months ago, he had this thesis that there was going to be another move up, and by golly, there was. So anyway, for what it's worth.
Yes, I mean, we could have probably a half an hour conversation on the fundamental concept. I continue to have, I guess what I'm waiting to see is a practical way to use it. So until people start walking into their, to buy their car or to buy their groceries or whatever else, utilizing.
That'll never happen.
Yeah. So then it becomes, then what is it? Is a store?
It becomes the one thing that money is not.
Is not, yes, which is consistent.
The only thing money is not. But it's quite an important thing.
Yeah. So
if you can show me, you argue that you can't see anybody walking into a store and saying, here's a Bitcoin.
Mm-hmm.
But I'll pose the opposite question to you that you should be asking yourself. Can you see anybody saying, oh, there's my money, my cash, which I've had for 20 years, and it's gone up consistently in value?
Yeah. Yes,
So,
but the cause, then you have to look at the cause of why it's gone up consistently in value. And the reason it goes up consistently in value is because people believe in it.
The reason money gets exchanged is because people believe in it. What is the value in a piece of paper? In fact, worse than a piece of paper, just a number on a sheet. What's the value?
The full faith and credit of the United States government.
And so the value in Bitcoin is the full faith and credit in the value of Bitcoin. It's not the full faith and credit in the United States government. It's in every country. It is the necessity to have faith and credit in that government.
Yeah.
You don't have an option.
Yeah.
You should think about that philosophically. The full faith and credit in the United States government is nothing but a concept.
Mm-hmm.
The paper that you have in your hand and the number that's on a piece of paper is no better or worse than the Bitcoin string of numbers that you have in your Bitcoin wallet. So I'm not troubled by that perspective. What I'm troubled by is the difficulty of holding a wallet and holding those numbers safe in a wallet and not losing them. That's a real practical problem.
Right.
And that's proven very flawed, because these individual organizations, which have risk, have sprung up to provide that as a service. And so that's a flaw in the whole problem, in the whole issue of the asset of Bitcoin. Anyway.
All right. Hey, Larry, it has been fantastic as always. And I guess I was right that since Cathie went short, we had to go long. But hopefully, if there's anybody left still listening, we appreciate you joining us once each month to take a look at what Cathie had to say. I think it was extremely valuable what she had to say, very insightful, and I think we might be at kind of a turning point. Now, 4 days does not a market make, and things could be completely different next week, and January could end up being completely different, but I do think it's valuable if you take it as a whole, and Larry's been predicting this for a long time. Larry, you're not unlike me. I've said for my entire life, my predictions always come true. They just sometimes come true 2 years later than I was thinking they would. So in your case, it might only be a year late for you on your recessionary prediction. All right. So any last thoughts, Larry?
Yeah, we should have listened to Stan Druckenmiller 4 months ago.
and bought it. Now, by the way, Larry, before Stan said it, I said it. You remember that? I said 5%. That's it. Tops out. So I beat him to the punch on that one. All right. Enough of this. We should move on. And Larry is working. My understanding is Larry is working on an analysis of the valuation for 2024 on the charging stations. That should be extremely helpful and useful. And so hit notify. And in order to hit notify, you have to hit subscribe. And then, of course, you should hit like just because. And so we'll have Larry back shortly.
Also, I'm working on pricing for the bot.
Pricing for the bot. Interesting. That's an interesting one. You heard it here first. And maybe Larry will even do it on our channel first. We'll see what happens. All right. Thank all of you out there. Thank you, Larry. And to all of you out there, it has been great talking to you.